So you can see a move like this, and obviously there's massive amounts of arrival of volumes and all sorts of things. So one of the big questions we've got is, and what? So what does this mean? So obviously the market does start to cycle quite nicely. You can see that if I can draw a line through this regression channel here, you can obviously recognize that the market is actually cycling. I know it's in a downtrend, but it is cycling in a downtrend. At least it's not a trending move. So therefore, cycling indicators in a downtrend, so long as it looks like this, are probably going to do quite well. I would imagine you could probably all agree with me that something like a stochastic would probably look pretty good during this period. So if I look at the stochastic during this period, you can see some of these trades. Now, this is a trading strategy that's in TradingView. It's a free strategy. And you can see, obviously, that when the market cycles like this, you can see that the sell trade was here. It was glorious. Now, they added to the sell trade just in here as well, which obviously meant a little bit of a drawdown during that period. But look at that cycle, how good that trade was. That was spectacular. Now, the buy trade maybe not quite so good. You can see, obviously, the buy trade getting caught on this sell trade here twice. And then they had a third add-in up here, which obviously potentially got them out of a hole in that one because of that third add-in there. And obviously they cycled it back into a buy trade here and then back into a sell trade. So even that, the tighter cycle is now causing them problems. Because of the tighter cycle starting to cause them problems now, because they're obviously not getting the top tick price, which obviously, you know, is fair diddles. Now you look at that and you say to yourself, I want that, right? Would you agree, Theo? You could look at that and say, yep, that's as good as it gets. That is as good as it gets. And you're being honest, because it is probably as good as it gets. I mean, it's not bad for a automated type process. Now, this sell went straight into profit. This sell lost a bit of money before going into profit. This buy lost a little bit of money before going into profit. This sell was kind of rank rubbish. This sell was perfect. This buy was poor. And this sell was okay. But depending upon the size of the stop, a few losses in amongst those trades. But take a look at the prior swing. So you're using this as a signal. What happened to you during the prior swing, guys? Well, you sold off of that trade there, and then you bought here. And then you bought again here. And then you bought again here, right? So all of a sudden, this probably hasn't actually made you any money. It's probably just very gingerly tried to make you some cash back, right? It's getting some of your losses back, right? So this is the problem with a retail type system like this, where you don't understand, you know, the concept of cycling. There's a very good chance that by the time you reach this trade, that would not have been a profit either, because ultimately, because of what's happened to these three buy trades, you'd have now be gun shy. And as soon as the price starts going against you here, you probably get stopped out. Because you're saying, I'm not going to let it go for any type of move against me, because I let these trades go against me and I get stopped out for terrible losses. And if you let any of these trades go against you, obviously the loss could be a substantial amount, right? So when you start seeing a trade like this, all of a sudden that psychology is now working against you. So you get stopped out in that trade, and then you think to yourself, right, I'm going to put in a really tight stop here, and you maybe got away with that one, but you didn't get away with this one. That one definitely stopped you out into that top edge, didn't it? So realistically, during that entire process, this trade here made you some money, but the previous three trades lost you money here, lost you money here, lost you money here. Actually, this one lost you money. This one lost you money. So you've had 2 winning trades and now 5 losing trades during that period. You might say, well, it's worth it because the market doesn't trend that often and I can survive those types of drawdowns and blah, blah, blah. Yeah, maybe. Maybe you can. Maybe that's absolutely right. Depending upon the size of your stop, perhaps your money management could start working. This buy trade here obviously lost money quite clearly. It got stopped out, and otherwise you were running a massive stop on it. And this sell trade, well, this sell trade's making money. Good. But it's only making as much money as you lost potentially on that stop there. In other words, the last 2 trades are effectively on a quits position. And if it breaks, the problem is you're going to have a buy trade coming in if it breaks, aren't you? You're going to start looking for a buy reversal. Now, that's one possible system. And you realize that inside of that system that you can see the market as a trending market, or you can see the market as a rotational market. And obviously, one of the things that you can then say is, well, I'm going to trade as a trending market. And obviously, you could put something like the super trend, which is followed by something like 50,000 people. And obviously, when the market breaks, it's a turtle trade, isn't it? You make a fortune when the market breaks. So if I put the super trend on it, you can see that the market super trend, if the market breaks, you kill it, don't you? You absolutely kill it. But remember that the sell trigger is here. That's where the sell trigger is. And the buy trigger is here. And there's an always in type trade, isn't there? The market is either long or the market is short. So when you look at a trade like that, you say, well, that trade there made me a fortune. It was 523 to 484. Brilliant, right? Massive profits. 523 to 484. Massive profits. So you're about 40 points up. 40 points up on the NASDAQ. That is a brilliant trade. And then, of course, you get long here and you get short here. So that's a small loss, isn't it? It's actually on that candle, my mistake. So there's your loss there. So it's actually a reasonable size loss. Okay, so it's about 10 points. Okay, so your 40 points profit, you've just lost 10 of those on that one. Now, the good news is you got that trade there, which makes you back some money again. So you got short here and you got taken out at that price there, 458. So you sold it at 472s and you made 14 points back. So you're back in profit again, to the tune of 44 points. But the current trade is long at 458s, currently trading 438s, and obviously that's a potential loss of about 20 points at the moment, right? And now the sell signals just came in. So you just lost 20 on that, which means you're 24 points up. So wait a second here. In a trending market, you're 24 points up on a 100-point move. Really? 24 points up on a 100-point trending move. Well, yeah, you're still in profit. But that's assuming we don't start adding in some of the sideways action that we had, a buy trade here and a sell trade there, for example, which obviously means that your 22 exit on a 33 long trade was another 11 points off, which means that you're now only at this stage 13 points up from 9 o'clock, right? And then prior to that, we had this sell trade that triggered here, which then exited here, which obviously was a trade at 25s, trading 35s. That's another 10 points off. So that means that at this point, if this was your trading at this point, right? If this was it, if that was your entire trade so far, you're currently in profit by the tune of 3 ticks. 3 ticks. 3 ticks. Now that looks like an incredibly strong trending move, doesn't it? And yet you're only in profit by 3 ticks. And that's with a trending indicator. Because the problem with trending indicators is very simple. They only start showing the trend when the trend is now clearly and obviously visible. Now, that's obviously the benefit of them as well, is that they'll get you into, if you get a $20,000 move, they'll probably be in it, right? The problem is that doesn't happen very often. Now, the buy trade prior to that was fantastic. So, let's be honest with the system. Let's give it a chance to prove itself. And the buy trade from that previous London Open was brilliant, but that's because it's a London Open. And now we start recognizing the value of something like a trending system, because the London Open is also a what? An RGL, right? So when we come into the 8 o'clock London Open, there it is there. There's 8 o'clock. This is an RGL, so we trade the volatility breakout of an RGL, and therefore this trade is probably legitimate. So we start recognizing that trade was probably legitimate right there. And obviously getting a buy trade there at 96 to a high price of 36 adds 30 points to the move. And now you're, for the entire day, you're sitting on 33 points. Fabulous. 33 points is amazing. And one of the other systems that a lot of people use, of course, is something like a moving average crossover. So when you're looking at moving average crossovers, of course, it's a very similar system to the super trend. And when you're looking at moving average crossovers, you can see, well, you can see that this is not the strongest performance, but it doesn't matter. You can see the moving average crossovers anyway on the screens. You can see that we had a long position up here for some peculiar reason. And then a short sale there, a long here, a short sale here, a long here, and then a short. Now that short makes a killing, doesn't it? That short there is still in. Absolute killing on the trade. Unfortunately, you had one loss, a scratch, 2 losses, 3 losses, 4 losses. You had 4 losses before that big rip lower. Now you might say, I'm happy with that. I'm happy to have 4 losses until we get one big rip lower. But here's the problem with that, isn't it? At what stage are you not going to be happy with how many losses you have in a row? At what stage? Is it after 5? Is it after 10? What do you think, Theo? Is it after 20? How many losses in a row would you be having before you're waiting for that big break? We don't know the answer to that question, do we? We would like to think we know the answer to that question, because if we have 5 losses in a row, you might say, well, I'm just going to reduce my exposures to the point where, and then you start coming up with some crazy dumbass system whereby on the 5th trade you start doubling the size, because surely you can't have any more than 5 losses. What are you starting to do, Theo? You're starting to play red and black in a casino roulette wheel, aren't you? It can't go red any more than 5 times. I've heard it in the casinos all the time. And you're saying, mate, seriously, it's got a 50-50 chance of it going red again. And he goes, no, it hasn't. And you just look at people and you say, wait a second, you don't think it's got basically a 50-50 chance of being red again. It's gone red 5 times already. And you're saying, and what? The roulette wheel doesn't have a memory. The roulette wheel doesn't have any idea that just because it was red before doesn't mean it can't be red again. You have a 50-50 chance. And some people just don't buy it. Some people just don't accept that that's true. And the law of large numbers, guess what? The law of large numbers doesn't come into play at 5. So yes, the probability is that it's going to be an average out, but that probability isn't going to start hitting until we start hitting maybe 100, 200, 300 spins, right? So in other words, it could be heavily skewed for 5, 10, 15, 20 spins. Heavily skewed. Because 5, 10, 15, 20 is not the law of large numbers. And because of that, you can't play this type of strategy in that way. You're going to get murdered. Absolutely murdered. So there's a lot of positives and a lot of negatives to these types of ideas. What we've got to do is be better than that. It's as simple as that. Be better than it. So when we bring in ideas, when we bring in indicators, the idea is we should have a fair idea whether this market is an inside-out market or an outside-in market. And we've obviously got some tools to help us with that. We can see here, for example, we can see that we have been trading this big sell-off here. So this is the NASDAQ here, and obviously that NASDAQ sell-off, we've been selling it. So in other words, we've been short selling the NASDAQ sell-off just like the best trending system, which is great news, right? And then we've been able to fade the bottom edge like a great RGL, like a great stochastic system. And we've been able to fade the bottom edge like a great RGL idea of a buy-side, sell-side level again, like a stochastic system. So in other words, we've got the best of both worlds. We've got the trending phase here to make the killing. And then we've got a bottom edge where we're able to fade to make the stochastic monies. And then we change our mind during this phase because we've got a big drop here. We allow the price to drop through into liquidity again. and then make a new decision from the lowest edge liquidity, which is still divergent and allowing us to make a decision down here. What else have we got? Well, on top of that, we've also got max VAR. And what max VAR tells us is a very, very straightforward storyline. Max VAR tells us we need to be really careful in this phase here. Really careful in this phase here. Because if max VAR is going up like this, I am not going to be stepping into 445 for a buy trade. I'm not going to be stepping into 440s for a buy trade. If it's not going to be bottom edge, it's not going to be anything. Max VAR tells me that that's the case. Max VAR tells me, for example, here that I can sell back into this top edge here. Max VAR tells me I cannot buy this unless I get a break of the bottom edge. Unless I get a break of a bottom edge, Max VAR is crystal clear about this. Max VAR tells me that unless I get a break of a bottom edge in here, I cannot, I should not, and I will not buy the bottom edge price. None of these other indicators tell me that. None of these other pieces of information that we have tells me any of that storyline. Let's revisit the bottom edge in terms of these other indicators. Let's visit the super trend. And the super trend just sold the bottom edge, didn't it? Look, the super trend indicator, followed by over 40,000 people, just sold the bottom edge. So the super trend's short. I haven't changed any settings to make it worse than it is. I've just taken it straight off the charts, right? So super trend is short. The moving average crossover, guys. Let's see what the moving average crossover. No triggers for the moving average crossover. Hasn't found a buy, still short, still making money. Let's take a look at the stochastic RSI. The stochastic RSI did find a buy trade. Woo-woo! Stochastic RSI found a buy trade into the bottom edge as well. Well, you would imagine that that would be true because we kind of knew that that would be true because of the fact that the market is cycling. So we could recognize that that was a point. But when we recognize that that was a point, we can recognize, of course, that we had to be really careful with that point because whilst the RSI and the stochastics recognizing that the market is cycling, I'm actually really concerned about the possibility that the market is cycling in here, right? I don't like it. I don't like it one bit. Do you not agree? According to Max VAR, this market is not cycling. So unless we get the bottom tick price, remember the stochastic RSI was buying in the break back above here. So the Max bought, the stochastic bought in here. Well, I would never buy in here based on the storyline of this. If I don't buy the bottom tick price, guys, in that area there, I'm not going to buy it at all, right? I'm not going to buy it at all. And because of that, we don't get stopped out on a drop like this. We're adding to a drop like this. See the difference? If you were trading that stochastic RSI story and you had bought there and the price rallied, there would be an incredibly high probability that your stop was now at this price at break even. You just got stopped out at break even if that's how you're going to trade it, right? We didn't get stopped out at break even, because we're obviously now recognizing that this is now a high probability add-in trade here. Because we already also knew that we had the narrative to go long into the bottom edges. So we already had this storyline stacked up in our favor. We can see the value was bullish, right? So we've already got the storyline stacked in our favor. The value is bullish. We've got a retest. We've got an idea that the market is going to cycle off the bottom edges. So we buy the bottom edges. We don't buy a candle reversal so that when we get a bad price, because we still recognize that we are on a weak-handed trade here, right? If I start buying at silly prices like this area here, I could put myself into a lot of serious risk on a sweep. We're buying the bottom edge for the cycle rejection. And that way we're able to take advantage ultimately of the best prices in the best locations with the best storylines. And we still recognize the weakness of our position because we are still very much in this downtrending phase. We haven't yet really hit it out the park on the buy side, but we can obviously recognize that this is building slowly but surely. So when we see this, we know how to approach it properly. You know, none of the other indicators has done that as an outcome, have they? None of these retail indicators has actually enabled us to do this. This buy indicator has reversed into a sell indicator just there. You can see that they've came in for a short sell just there. And they did well on that one, didn't they? They did well because the market did cycle back round again beautifully. We can see the super trend guys, well, they sold there. So what does it? So you'd obviously hold that as a stop. Well, yeah, fair enough. You'd hold it as a stop and you're probably still in that short and it's making you nice money. Good. Makes a change because you're not making very much considering you've had a brilliant trending market today and you're only making something like at this stage about 30 ticks profit. You might say, well, 30 ticks profit, more than I'm making right now. Well, if that's the case, you're not a very good trader. So, yep, certainly cycling sell here now. Good trade, nice outcome, great stuff. Because a stochastic in a flat market will be very good. It should be very good. That's what it's built to do, is to be able to trade in those types of cycling markets beautifully. So this is the problem when we start looking at indicators, is that they are too, well, they're just not descriptive enough. They are too simple, if you like, trying to take advantage of a simple condition that is there, not adaptable. It's not dynamic, if you like. It doesn't recognize the change in the market environment. And because of that, of course, it's going to throw up some really terrible false signals. Really terrible false signals. And a lot of people will say, I think this is quite good. Well, really, even in a flat market, this signal's been poor. So in a flat market, this signal's actually been really poor here. That trade in a flat market is not good, guys. That buy trade to that sell trade there is not good in a flat market. Equally, that sell trade there to that buy trade there in a flat market is not good. I mean, you're literally making about 1 or 2 ticks on each of these rotations at that stage. And yeah, this one's widened. And you've done okay with this because the spread's starting to widen. So there's 2 market conditions that you're finding that are going to look kind of really cost you, and that is a tight market and a wide market. So you need a kind of Goldilocks type market for you to make money, don't you? A Goldilocks market as in a market that doesn't trend very far, but trends enough to get those bid offer spreads extending. That's the difference, guys. That's the difference. Anyway, New York Fed manufacturing comes in at 11.5 and the Canadian manufacturing comes in at 1.4. So pretty hot numbers. You can see that for yourself. Pretty hot numbers for the New York Fed manufacturing index. 11.5 positive. Forecast at minus 4.7. And quite a strong number there. And obviously the market not mad keen on it. Not disappointed. I don't think the market's going to be disappointed with a positive number, especially when there's the sell side business getting done today. But, you know, they're not madly keen on the number either. It's not going to be enough to change the Fed's mind about anything. So I don't know how important it really is today.